Okay, dear students, this is Mustafa Mirchawala from Mirchawala's Hub of Accountancy, your SBR trainer, and today I'm gonna record a class for you guys on request of my students. Especially some students requested me to give idea on this SBR pre-mock. So I'm gonna touch this practical area of this consolidation, and that will be definitely useful for you. So without wasting any time, let's start it. So Helliwell company operates in the film industry. It operates financial statements. It prepares financial statements in accordance with IFRS accounting standards. The financial year end is 31st December X7. Keep this date in mind. Very important for you. Okay. Now the following exhibits available on the left hand side of this. Oh, okay. So there are three main areas: acquisition of Carter, then investment in Bala, and then we have a financial asset fair value through OCI transaction. Okay, right. So let's start with this first thing. On 1st March X7, it looks like a part year mid-year acquisition because your year end is 31st December X7. Okay, so they are saying it's 1st March X7. Each company acquired 80% of 8.9 million pound one ordinary equity shares of Carter. Okay, so parent company is H company and Carter is your subsidiary company. Okay, and this is the ordinary share capital of subsidiary company, total ordinary share capital, and out of this we have bought 80%. Okay, now prior to its acquisition by Helliwell company, Carter had produced several unsuccessful films. Okay, that means the condition of subsidiary is not good. Helliwell company agreed to make an immediate 2.4 million cash payment. This is cash consideration. Okay, as well as a further 6 million cash payment in 3 years time if agar, I say in Urdu, if Carter achieves a required level of box office revenue during that time. Okay, so this is contingent consideration. And my dear student, if you have taken lectures, you know contingent consideration is sometimes treated as equity and sometimes it is treated as liability. Now just recognize it by looking at the screen. In this question, it is equity or liability. It is definitely a liability. Why? Because we have to make a cash payment. See, we have to pay cash in 3 years time. So whenever you need to pay cash, so it is always a liability. Now, do you guys remember the treatment? This all F7 level treatment. Do you guys know the treatment of contingent consideration if it is a liability? Yes, let me recall you. First of all, at the date of acquisition, you will record it at fair value, and in the post period, if there is any change in fair value, yes, at the year end, at the reporting date, you need to bring liability at fair value, and now the post period changes in fair value will go to the P&L. P&L here means the parent company's retained earning. It will go in the parent company's retained earning because parent company promised to pay this contingent consideration. So whatever will be the future fair value fluctuations, it will affect parent company's P&L. Okay, now at 1st March X7, the fair value, okay, at 1st March X7, the fair value of the contingent consideration was determined to be 3.56. See, this is the initial COI. Okay, this will be part of initial COI. By 31st December X7, Helliwell performance had improved and the fair value of this contingent consideration was measured at 4.5 million. Now very easy, let me make the entries for you. Wait. It will, listen. This is 1st March X7 and this is going to be 31st December X7. So the fair value here is 3.56 and here it is fair value 4.5. Very simple, be confident. So here it will go like this: debit investment, credit contingent investment debit and contingent consideration credit. Okay, so this is the initial entry. Now as this transaction is a liability, so yes, at the year end you need to bring liability at fair value. So how much will be the change now? In the future the change will be 4.5 minus 3.56. Point 94. So the entry will be, listen, just think parent company promised to pay this. Okay. So this will be a pure expense of parent company. Liability is increasing. So debit P&L, or you call it retained earning debit 0.94, and yes, your contingent consideration will be increase. Okay. So this is the entry which you need to post. But be careful. This is pure parent company's expense. This has nothing to do with NCI. Why? Because parent company promised to pay this amount to the shareholders of S company. So this is pure parent company's expense. This is the question of SOCI. Be careful about the breakup. So this first entry will be the part of goodwill, and the second entry will be the part of income statement, as this is the income statement question. Complete expense for parent company. Now I'm just giving you oral instruction. In this question you need to discuss this as well. See the requirement number A. They are saying using exhibit 1, explain with calculation. Both things you have to do, explanation with calculation. How the correct treatment of the investment in the Carter in consolidated financial statement for the year ended 31st December X7. Your answer should include calculation of any goodwill or gain on bargain purchase. I am going to do it. Okay. So for this thing, this contingent consideration area, give the headings and then first define what is contingent consideration, that it is dependent on certain events, not wholly controllable for the organization. Okay, like it's like a what if payments, and it is this time this contingent consideration is a liability. So what we'll do, you have to write like this. Initially it will be recorded at fair value of 3.56 million, and then we need to bring this contingent consideration to fair value at the year end, and whatever will be the change in fair value, it will hit parent company's P&L or parent company's retained earning. This is how you need to write. Very simple, very simple. Okay, give positive message to your mind. These are ending days. Okay, give confidence to your mind. Next thing, now they are saying on 1st March X7 Carter's retained earning. Okay, so as we have to calculate goodwill, so we need to make the acquisition date equity packet, net assets packet of S company. So Carter's retained earning is 26.6. Yes. And yes, the total of other components of equity and retained earning is 26.6. On this date, the fair value of 20% shareholding in Carter is 7.12. This is fair value of NCI. This is fair value of NCI, as this is the full goodwill method. So fair value of NCI is also given. Helliwell has chosen to measure the NCI at the acquisition date at fair value. Okay, excellent. Carter produced and owns the rights to one of the first films ever made. However, Carter has not recognized this as an asset in its individual financial statement. Helliwell attributed a provisional fair value of 1.4 million, please active, to these rights on 1st March X7. After completing a full fair value exercise at 31st December X7, it was determined that the rights had a fair value of 1.6 million as at 1st March X7. This is relevant. Now let me tell you the whole story. Listen, I hope you remember this thing, this area. This is P company and this is S company. Listen, this is very basic. Even we teach this in F7, FR level. Sometime it happens that at the date of acquisition, there are some unrecognized. There are some unrecognized intangible assets in the S company's books. For example, internally generated brand. S company has launched an internally generated brand few years ago. So now internally generated brands are not recognized in our own financial statement. So in S company's own books, in S company's individual books, this internally generated intangible has not yet recorded. Okay, but for the parent company's point of view, parent company has just bought the subsidiary. So for parent company, it's a purchase intangible. So now for the group point of view, we need to give birth, we need to recognize, we need to recognize such intangible assets, and it is simply treated as a fair value adjustment. Like we have to do like this: C is equal to A minus L, and we will give birth to an asset, so a corresponding increase in net asset as well. So it is nothing but a fair value adjustment. It is nothing, my dear student, old example, not nothing new, but a fair value adjustment. But yes, in fair value adjustment, you all remembers in SBR level we teach in class a 12-month rule. A 12-month rule, my respected, my beautiful students, a 12-month rule. Remember, what is the 12-month rule? The 12-month rule says if at the date of acquisition you are not fit, you don't have enough resources to calculate fair value, okay, or there are some hurdles in calculating the fair value, so in that case, you have 12 months, from the date of acquisition. If you have calculated the fair value within 12 months of the date of acquisition, this new fair value will be treated as if you have calculated the fair value at the date of acquisition. And yes, this new fair value will be used in goodwill calculation. So respected students, this 1.6 million is the real value. Okay, no matter we have calculated this at 31st December X7. 31st December X7 is like 10 months from 1st March. So yes, it is within 12 months. Now, as a student, you may ask, sir, is there any extra depreciation for this? No. Why? The rights are expected to have indefinite life. There is no definite life. Good news. So only fair value adjustment. Okay. So don't forget, this 1.6 million is an upward fair value adjustment. Okay. Now last thing, during Feb X7, like 1 month before the acquisition date, one of the Carter's camera operators brought a legal case against because of an injury suffered during filming. Carter has disclosed a contingent liability in its individual financial statement. The fair value of the damages was 430. Yes, one more thing, one more routine issue. Contingent liability issue, F7 FR level. Yes, we have covered this in strategic level as well. Let me show you. You know, at the date of acquisition, if S company has a disclosure note, if S company has a outstanding case in its individual financial statement, and for that case, if you have recorded a disclosure of contingent liability, if parent S company has already recorded a disclosure of contingent liability, now what parent company has to do? Parent company has to recognize, for the purpose of consolidation, for the purpose of goodwill calculation, parent company has to recognize this. Parent company has to recognize this contingent liability at fair value. Okay, so this will be treated as a fair value adjustment liability. And how to do it? Just see the screen. If you give birth to this liability, if you recognize this liability, your net asset will go down. So in the net asset packet, as this is the question of only net asset accounting, because you just have to calculate goodwill, so as the liability will go up, your net asset will go down. So you'll have to write a negative number of 430 in the net asset packet. You'll have to write a negative number of 430 in the net asset packet, in the net asset packet. Okay. Now we are very close to the goodwill calculation. Don't worry. Now what they are saying, Carter's income, expenses and other comprehensive income from its individual financial statement have been included in a line by line basis. Yes, they have already did consolidation. In the draft consolidated profit and loss, the resulting profit and total comprehensive income have been allocated between the owners of Helliwell and the non-controlling interest. However, golden lines. However, no other entries adjustment relating to the Carters have been made. That means normal consolidation they have already done. Everything for income statement they have done except for the adjustments we have just read. Except for the adjustments which we have just read or we are going to read. Okay. So we need to post those new adjustments. We need to post those new adjustments. Okay. So my dear students, please, exams are near. If you want to take the picture of this paragraph, because I'm going to move the screen, I'm just gonna calculate goodwill for you. Okay, let me do it for you. So now we have, okay, so we have, for goodwill calculation, we have a cash consideration of 20 to 24 million, means 24,000, right? Then we have contingent consideration at the date of acquisition was 3.56, means 3560. Okay, right? If you add these two, it will be 27560. Now, next thing is, these two make up like 80%. Now, fair value of NCA at acquisition was 7120. 7120. Okay. Now, this is all 100%. Now, fair value of net assets of S company. Let's start. So you have to make the packet of fair value of net assets. You have ordinary share capital of 8.9 million, which is 8900. Then they go and check. You have just taken the picture of you, or if you want to rewind, you may. The acquisition date retained earning, the acquisition date retained earning and the OCE is 26,600. Now the next thing is fair value adjustment of an intangible asset, the rights to film. The rights to film is 1.6 million, it's 1600. And then we have a contingent liability fair value adjustment. Liability fair value adjustment goes as a negative number of 430. So if you adjust all these, this will be 36,670. Now, can you use your common sense? Come on, take the difference. You will get a negative number, and the negative number means negative goodwill, and we give a special name is gain on bargain purchase. There is a gain on bargain purchase. 1990. Okay, now my respected students, this gain will directly, this is a pure income of P company, pure income of P company, no share to NCI, no share to NCI. Why? Because this is the deal of parent company, this is the mind of parent company, this is the negotiating power of parent company to 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 get it, to get this, to get this cheap deal. What do you mean by gain on bargain purchase? That means you bought a thing, a something cheaper, in cheaper rate, like fair value of net asset is higher but COI is lower. So this is the mind of parent company. That's why this pure income of P company, no share to NCI. If it is a balance sheet question, SOFP question, this will go in parent complete go, this will complete go in retained earning, consolidated retained earning, no share to NCI. And if it is an income statement question, purely income of parent company, no share to NCI again. Okay. In this question, don't exit this question. I'm going to share some basic techniques of income statement. When I'll shift to the pre-populated area, I'll give you some special training, so it will be useful for you. Okay, now this part is done, but yes, you have to explain each and everything. Like you have to explain contingent consideration, which I told you. Then you have to explain this 12 months issue and fair value adjustment of unrecognized intangible assets, and the 12 months rule you have to explain. The third thing is contingent consideration you need to explain. Sorry, contingent liability issue, that the contingent liability must be recorded at fair value at the date of acquisition for goodwill calculation purpose. Okay, so all these three issues you need to discuss, and then this practical area. Now in this question, what are the areas of posting? This 1990 will be posted. Okay, then what else you need to post? You need to post this thing, these two entries we need to post in the income statement. These two will go in the income statement, this and this gain on bargain purchase. But yes, purely parent companies related, both are purely parent companies related, no share to NCI, no share to NCI on both transaction. Okay, so let's move to the next part, the B part. It's about the treatment of investment in Bala. And you know what is it? This all about? It's about associate, foreign associate. Very simple. Foreign associate. Very, very simple. Foreign associate. See this. The Helliwell group has a presentation currency of dollars. That means our presentation currency, parent company's presentation currency is dollar, and it is normal in all questions, on 1st October X7, like 3 months before the 31st December. Okay, 3 months before 31st October, November, December, just 3 months. Helliwell bought 35% of the equity shares in film studio Bala, which has a functional currency of the remini. Okay, that means the currency is different. Okay, the investment cost RM 136.4 million and gave Helliwell joint control over Bhala. Helliwell determined that Bhala was a joint venture. Now just apply brakes and go relax. There are two types of joint IFRS 11. If you have done IFRS 11, so with joint control, there are two types of accounting. One is joint operation and the other one is joint venture. Sorry. One is joint operation and the other one is joint venture. What we do with joint operation, remember, we have to take all our share of things like PPE, inventory. If we have 40% or 50% share with the inventory, everything will be recorded in our books according to our share or whatever assets we have in that new business, we just record it. Okay, so in joint operation we have rights in assets, directly assets, but in joint venture we have rights in net assets. Okay, for joint, just I'm giving you extra things. So for joint venture, you need to do equity accounting like associate. So just don't think too much. It is a pure associate question. It is like a pure associate question. Okay. It is like a pure associate question. So how you do associate question? It's equity accounting, but yes, there is a foreign transactions included. So don't worry about it. I'll explain you. Bala reported a profits for 48 RM. See, this is in for RM 48 million in the year ended 31st December X7. So it's the profit for the whole year. It is the profit for the whole year, but we have to apportion it to 3 months because we acquired, my dear students, see, we acquired on 1st October X7. See the screen. So from 1st October to 31st December, only 3 months profit we need to take. Relevant exchange rates are now. This is the first exchange rate of 1st October. The COI will be translated on this rate. Then closing investment will be translated at this rate. And yes, the average rate is, this is for profit. This is for post retained earning or profit. Automatically you will get an exchange gain or loss on this foreign operation. Automatically you will get an exchange gain or loss on foreign operation. Okay, in the draft, read these lines. In the draft consolidated financial statement, the accountant has recognized the investment at Bhala at cost, only this thing, and translated using the exchange rate on 1st October X7. At least this is correct. The first step is correct, but no further steps have been taken. No other accounting entries relating to Bhala have been made in the draft. Okay. I would again request you to read this paragraph complete again and take a picture so that I'm going to move the screen. I'm going to move the screen. Okay, so let's start. And this is requirement B. Okay, see, this is requirement B. 6 marks. Not bad. 6 marks. Very good marks. Okay. Now what we'll do, we'll first write COI. This is RM. This is dollars. Please check it out. Okay, two currencies. Then add post profits of, name of the company is Bhala. Yes. Okay. Then we have C, closing investment value. Now just concentrate and just look at the screen carefully. The first thing, COI was how much? It was 136,400. COI was 136.4 million, which is 136,400. Okay. They have written the question in millions, but definitely we need to apply extra 3 zeros. Now, what is the exchange rate? The rate at acquisition at 1st October, the rate was $1 is equal to RM22. $1. Okay, this is the rate. And now we have to shift from dollar to, sorry, we need to shift from RM to dollars. RM to dollars. So 22 RM is equal to $1. 22 RM is equal to $1. So dollar is a smaller number. So we need to move from bigger to smaller. Now we need to divide. Very simple common sense. Go divide it. 136,400 divided by 12 will give you $6,200. Okay. Now let's calculate the post profit of only 3 months, not 12. In the question, the profit is 12 months. 12 months profit is given. You need to apportion it. Don't forget a small mistake. So it will be 48 million 48 million into 3 upon 12. It will be 48 into 3 upon 12. This will give you 12 million profit. But yes, 12 million multiplied by your holding percentage. 12 million multiplied by your holding percentage is 35%. So 12,000 into 35%. 12 million into 35% will give you 4,200. Okay, so this is your post profit. This is your post profit. Okay, proper profit in RM. Now use the average rate. Profit is a for the year thing. Profit is a for the year thing. Hope you remember my lectures. So what is the average rate? So average rate is $1 to RM20. So this will make 210. Okay, now can you calculate closing investment? 130 in RM. First calculate RM. Just giving you one hint, I have recently recorded a class of foreign subsidiary and I did the goodwill impairment calculation like this. This is the same method. So now 136,400 plus 4,200. Can you tell me what is the amount in RM? 136,400 plus 4,200 is 140,600. This is your closing investment. And for closing investment, you need to use closing rate. And the closing rate is 19. So $1 into 19. So 140,600 divided by 19. 140, it's 7,400. It's 7,400. Now use your brain. Some special thing is coming. Listen. See this. Opening investment was 6,200. Plus this is the post profit. 6,200 plus 210 will give you 6,410. So by the year end it should be 6,410. By the year end it should be 6,410, but now it is 7,400. So it went up. Why? Because of exchange difference, because of exchange gain. So you have an exchange gain on foreign operation, and that definitely you know this thing, that gain goes in OCI. Exchange gain goes in OCI today, and later on when you sell it, exchange gain on foreign operation goes in OCI today, but later on it is transferred to PNL, right? So this is 990 exchange gain. Now as a student you may think, sir, are we going to give any share? Are we going to give any share to NCI for this? No, never. No, never, not at all. This transaction has nothing to do with NCI. Why? See, simple. Parent company has just bought 35% shares of Bala. So this associate has nothing to do with NCI. Okay. So now these two things, this is first and this is second. These two things we have to post in SOCI. So this will go in income. This is income. You know what is equity accounting? In equity accounting, the other company's profit becomes your profit. What we call it, associate share of profit. This is what is associate share of profit. Associate share of profit. It will directly go in the consolidated PNL. It will directly go in the consolidated PNL, and it is the pure income of P company, no NCI share. And this will go in OCI section. Again, it belongs to P company only. P company only, no NCI share. No NCI share. Okay. Right. And now finally, you need to write these things in theory. 6 marks including explanation. So you will write about the foreign operation, foreign associate, that initially COI, just whatever I have done you have to write. Initially the COI will be recorded at the exchange rate of 1st October X7. Then in equity accounting we need to adjust the post profits, but profits are a for the year thing, so we need to translate using average rate. Then finally the closing investment will be recorded. The closing investment will be recorded at the closing rate. So you will get a balancing figure of foreign operation, exchange gain on foreign operation, which will be reported in OCI today, and later on when it will be sold, it will go in the P&L. Okay, so two things finally we have to post. You need to address this issue like this. So nothing difficult. It is manageable. It is manageable. You guys have done this in your exam kit in your class. Now we have last requirement. We have one last requirement, and that is the pre-populated requirement using, now they are saying using exhibit 1, 2 and 3. See, we have not discussed 3. Is this 3 is about the financial asset fair value through OCI. Financial assets fair value through OCI. Okay. Adjust the pre-populated spreadsheet to correct the extract for the draft consolidated statement. Don't worry, I'll show you it in Excel and we'll do it in Excel. Don't worry about it. Okay. Now, first, this is the exhibit 3. This is the exhibit 3, financial asset at fair value through OCI. Just let me recall you, you guys have done in the class in IFRS 9. If you have two investment sector like equity and debt. With debt, if you are investing in debt, now there are three categories: fair value through PNL, amortized cost, and the third and the middle category is fair value through OCI debt. Remember fair value through OCI debt and how we have to account for this fair value through OCI debt. Listen to me very carefully. In the income statement, it will be booked like pure amortized cost accounting. Effective interest rate, same, everything same as amortized cost accounting, but in the SOFP, it will be recorded at fair value. So at the year end, when you will bringing it to fair value, at the year end, when you will be bringing it to fair value, the fair value change will go in OCI. The fair value change will go in OCI. Okay. So they are telling you a history. On 1st of January X6, Helliwell invested $10 million in 5% loan notes. $10 million in 5% loan notes that are redeemable at a premium in future. Okay, so we have to start the table from 1st January X6 like last year, and this 5% is the coupon rate. Now the effective interest rate is 8%. Yes, interest income will be booked at this rate. The loan notes, and see, this is invested loan. We have done investment in the loan note. So we are going to book interest income, not interest expense. The loan notes were classified and measured at fair value through OCI, and they were correctly reported in the consolidated statement of financial position at 31st December X6 at their fair value of 10.42 million. So the last year accounting is perfect, but still we are going to do it for you. The accountant has made no accounting entries in the year ended 31st December X7 other than to recognize interest received as finance income. That means physical interest. That means they have only booked physical interest of 5% as an income, nothing else. They have only booked physical interest of 5% as an income. So they haven't booked complete interest income using effective interest rate method that we have to do. Finally, the fair value of the loan note at was 10. Yes, year end fair value is 10.65 million now. So no need to worry about it. Just take the picture, just read this line, and I'm going to do it for you. I'm gonna do it for you, don't worry. Let's start. Okay, so you have amortized cost brought forward. The initial level was 10,000. The initial, I'm going to solve it like 1 year back. 1 year back, your initial value was 10,000. Then you have interest income column, which is 8%, then interest received column, which is 5%. Okay, fixed 5%. So physical interest, just calculate one time. You know the basics. Physical interest we always calculate just one time and then use throughout the question. So physical interest is face value, which is 10,000, multiply by 5%, so it's 500 fixed. This is fixed 500. Okay, now so 10,000 multiplied by 8% is 800. Out of this, 500 is the physical interest. So amortized cost carried forward at the year end is 10,300. Okay, 10,300. Now the next thing is very important. The next thing is very important. The fair value at year end. So at the first year end, the fair value was at the first fair year 10420, 10.42 million, 10420. So at the year end, you need to bring it to fair value. So from this number to this number, how much is the change? 120. So fair value change is 120. This 120 will go in OCI. And yes, it has already gone. It has already booked in the OCI last year. This is the last year accounting. This is the last year accounting. Okay, 31st December X6, I would say. Right now we have to do the next year accounting, which is 31 December X7. 31st December X7. Now be careful, a little non-routine topic. This is little non-routine topic. So your fair value was 10420. Now you will write 10420 here, right? But now you need to calculate interest income. For the purpose of calculating interest income, just go purely amortized cost. Just go purely as a amortized cost accounting. In the income statement, it will go pure as amortized cost accounting. So for amortized cost accounting, your last year closing balance, see the screen, your last year closing balance was 10300. So you assume it that the opening balance is, no doubt you have written 10420. No doubt, no issue, you have written 10420, but keep this thing in mind that the opening balance for amortized cost is 10300. Now apply interest income 8% rate on 10300, not on the fair value. Okay, I repeat, income, let me say this in Urdu, इनकम स्टेटमेंट में प्योर एमोटाइज कॉस्ट अकाउंटिंग चलेगी, प्योर एमोटाइज कॉस्ट अकाउंटिंग चलेगी, जैसे करते थे एमोटाइज कॉस्ट का टेबल. ओके, सो इन और एमोटाइज कॉस्ट के टेबल में हमेशा हम एमोटाइज कॉस्ट को इंटरेस्ट रेट से मल्टीप्लाई करते थे. एमोटाइज कॉस्ट का जो लास्ट ईयर का क्लोजिंग बैलेंस होता था उसी को इंटरेस्ट रेट से मल्टीप्लाई करते थे. सो माय डियर स्टूडेंट, no issue, no matter you have written here the fair value of the previous year, but for the calculation of interest income, this 10300 multiplied by 8% will give you 820, will give you, I think, sorry, 824. Again the physical interest is 500, so 824 minus 500 is how much? 324 plus 420, 324 plus this is 10744. Okay, now tell me what is the fair value. Now tell me what is the fair value at this year end. The fair value now is 10650, 10.65 million, 10650. Okay, so you need to bring investment from this value to this value. So now it's a downward, and you know, in fair value through OCI, all upward and downward, everything goes in OCI. Everything goes in OCI. So how much is the negative amount? 94. 94 is the negative amount. 94 is the negative amount to which is to be reported in OCI. Okay, now my dear students, listen. Last year, that is 31st December X6, everything is booked. Just ignore it. Okay, for the current year we need to do just two things. In the current year, which is 31st December X7, the actual interest income which should be booked is 824. The actual interest income which should have been booked is 824, but they booked only 500. Go and read the question. They booked only 500, so the additional interest income is 324. Interest income No need to make any entry, leave it. Income to be booked by P company. Okay, this is pure P company's investment. Pure P company's is 324. So when you book this 324, your parent company's profits will go up. So automatically consolidated profits will go up. And it has nothing to do with NCI. I again repeat. Okay. And then this is OCI. Fair value. This is negative, so it's a fair value loss. Fair value loss of 94 will go in OCI section. Again, it is purely related to parent company, nothing related to NCI. This is pure P company transaction. I'll show you. We'll read it together. Okay. And yes, there is no SOFP in this question, but if this question would be an SOFP question, then this 10650 will go in the SOFP year end. Okay. Done. Done. Okay. So let me show you the last part as well. See, Helliwell invested. See, it is written Helliwell invested. This is pure parent company's investment. Pure parent company's investment. So now what we need to post, let me show you. In the adjustment number 1, this is the one entry. See, this is one entry which we need to post. Then this gain on bargain purchase we need to post, pure parent company income, both parent companies income. Then this 210 we have to post. I have already discussed. This 990 to be posted in OCI. OCI again belongs to P company only. And here two things. This 324 interest income, definitely it's an income, so it will go in the profits. And this 94 loss will go in OCI. So all 6 things, I am telling you openly, all 6 adjusting entries to be posted in by P company. All 6 entries related to parent company, nothing linked to NCI. Nothing linked to NCI. Okay. Now we have to move to the pre-populated section. But before we move to the most important part of this class, the objective why I'm recording class is now I'm telling you. Now, before we move to the pre-populated, there are only few questions of consolidated income statement in your past papers or in your kit. So you must have some grip on it. If it comes in the exam, you might do some mistakes. So let me show you one basic income statement, giving you basic training, and then we'll move to the pre-populated part. Okay, but keep this thing in mind, that 6 things we have to post. And you can also take the pictures by rewinding this class, so that when I'll be moving to the Excel, you can easily pick it up. See the screen. This is one of the basic question, F7 level question. You can see on the screen. You can see. Okay. Now, first thing, listen to me. See my screen. Check my video. For example, this black pen. See the screen. Even I have made short videos on this in past. This black pen is parent company's income statement, and this white pen is S company's income statement. Okay. So first thing, keep in mind, if something is linked to parent company's income statement, any expense or any income which has not yet been recorded in parent company's income statement, so that means the problem is in parent company's income statement. So we see the screen. We just simply do adding together. Adding together. So whatever bad things present in the parent company's income statement will go in the consolidated income statement as well. Okay. So if there is a problem or anything good, anything better in the parent company's income statement, that thing will automatically be transferred to consolidated income statement, and that thing is only need to be corrected in the consolidated income statement. That's it. No NCI. But If, see, this white pen is S company's income statement. This white pen, let us say it is S company's income statement. So if there is any problem in the S company's income statement, so this S company's income statement also goes in adding together. This S company's income statement also goes in adding together. So that problem will be transferred to the consolidated income statement first, and then this S company's income statement profit after tax is used for the calculation of NCI. So now we need to correct NCI as well. Okay. So this is the first training which I have given. Now see the second training. Let me enlarge the income statement. You have one income statement in front of you. Now examiner, the question which I am going to tell you, examiner will start question from this profit. See, from this total profit in which we add everything 100%, parent and subsidiary. This is the normal income statement of consolidation. So everything we add 100%. So now the question which we are just doing, examiner will start from here. So use your common sense, common sense. If any transaction of parent company is missed from the above income statement, so that means of parent companies, so that means it will definitely full time affect this profit. So you need to add or less from this profit completely. Let me say this in Urdu. अगर पेरेंट कंपनी की कोई ट्रांजैक्शन ऊपर की इनकम स्टेटमेंट से मिस हो गई तो वो इस प्रॉफिट को फुल टाइम इफेक्ट करेगी. डायरेक्ट आप ऐड और लेस करके इस प्रॉफिट को सही कर देना. I am repeating things in Urdu as well because some students are Urdu guys. Now, if something related to S company we have missed, so definitely S company also comes in adding together. S companies also come in adding together, right? So that thing will also be completely added or subtracted from this total profit, because right now this is total profit calculation. In Urdu class I say हम ही हम, अभी तो हम ही हम करके ऐड कर रहे हैं, right? So first of all you need to correct this profit, and then if there is any transaction of OCI you need to write here plus minus completely. See, so that if this figure would be correct, then finally your total will be correct. So first and the foremost thing which you have to do is you need to correct total profit and total comprehensive income. This is your first duty, and in this whole area everything is added 100%. Either parent company or subsidiary, even the subsidiary company things are also added 100%. Okay, yes, later on we do breakup, but here this is almost 100, everything full. But the good news is that in this question all the transactions are of parent company. Okay, now the next thing, listen, hope you remember these lines: profits attributable to equity owners of P company, NCI, and then profit. And same is the case with total comprehensive income attributable to equity owners of P company. These three lines for profits, and then again these three lines for total comprehensive income. Okay, so what we do, listen, this profit goes here. See, this profit goes here, and then when I teach normally in class, normally we calculate NCI, and then this is the balancing figure. This is the balancing, equity owners of P company is a balancing figure. But the question which we are just going to do in 2 minutes, in that question there is no NCI is given, and there is no way we can calculate NCI. There is no NCI is given, and there is no way we can calculate NCI because as companies profits are not given. So now what I will do, I have this number and I will calculate this number now. And this NCI will be a balancing number then. Okay, but for the calculation of this number, see, this is profit attributable to equity owners of P company. So whatever, this number will also be unadjusted. In the exam right now you will see this number, equity owners of P company, will also be unadjusted. So whatever you added here or subtracted here, you need to add and subtract everything here again. Because If the transaction is purely linked to P companies, so it will also hit the equity owners of P company. Let me say in Urdu. आपने जो कुछ यहां ऐड और लेस किया होगा ना इस जगह पे, वो यहां भी आपको करना होगा, क्योंकि इस बार क्वेश्चन में जो भी ट्रांजैक्शन, जो 6 ट्रांजैक्शन है वो सारी पेरेंट कंपनी वाली हैं, पेरेंट कंपनी वाली हैं, तो पेरेंट कंपनी वाली ट्रांजैक्शन पेरेंट कंपनी के इक्विटी ओनर्स को तो हिट करेगी ना, तो यहां वापस से करना होगा। ये नंबर एक बार निकल आएगा तो फिर यू विल गेट एनसीआई। सॉरी आई सेड दिस इन उर्दू हिंदी, बिकॉज वी हैव उर्दू हिंदी बॉयज एज वेल। Then finally, listen. Then finally, you will write. Then finally, you need to calculate these 3 lines: 1, 2, and 3. Now, this total comprehensive income will come from here. This total comprehensive income will come from here. Directly copy paste. Now, out of these two, again, you cannot calculate NCI in this question, because this question NCI is not given. NCI details are not given, so you need to calculate the balancing figure of NCI. So you need to work out on this. Now, wait, please hold. This is total comprehensive income, and you know how to calculate total comprehensive income in your life. You did final accounts. You have studied FR paper, F7 paper. Total comprehensive income is PAT, add OCI, then you get total comprehensive income. PAT plus OCI, you get total comprehensive income. So just think, if something is not adjusted in the PAT, that means it has not adjusted in total comprehensive income as well. So now, in order to calculate this amount, you need to adjust all profit related things here, all profit related things as well as OCI things. You need to adjust all profit related things as well as OCI things. Means whatever you adjusted here, you need to adjust here as well. Again, this is the mathematical issue, if you can understand. Because we are doing separately, we are doing both of these things separately. So in this total comprehensive income, you will write this total comprehensive income from the question here, and then NCI is the balancing figure. So how can you calculate balancing figure? By first working on this upper number, total comprehensive income attributable to equity owners of P company. And for the calculation of total comprehensive income attributable to P company, you need to adjust profit things as well here. Let me say in Urdu. भाई टोटल कॉम्प्रिहेंसिव इनकम कैलकुलेट होती है कैसे? प्रॉफिट आफ्टर टैक्स प्लस ओसीआई. तो अब ये अनएडजस्टेड गिवन होगी, एग्जाम में आपको ये अनएडजस्टेड गिवन होगी, तो इसमें प्रॉफिट की चीजें भी पहले एडजस्ट करना, ये वाली ऊपर वाली, तब जाके तुम्हारा आंसर सही आएगा. I tried to do my full effort, but now don't worry about it. Let's move to the question. You still have time, you still have the question. Don't worry about it, and you have a very good brain to think. So don't worry about it, and don't be dependent too much on your teachers. Okay, so this is our question. If you need to take the picture, you may. Then there are 6 entries total. Now we won't take much time, just 5, and just we need to post few entries and then it is done. Okay, the last part is always easy, the pre-populated. Okay, see, you have a complete Excel file or spreadsheet file in front of you, my dear students. See, now the first, on the left hand side, see this first heading, profit for the year. This means the total profit of the whole income statement, total profit. Remember the first income statement of consolidated, they have given you this 45650, and yes, it is unadjusted. Unadjusted means the adjustments which we have just done are not yet posted, so we need to post it. Okay, so for your easiness, for the time saving, I have given these headings in the exam. See the top headings. Top headings will not be given in the exam. These top headings will not be given in the exam. Okay, be careful. So the first thing is gain on bargain purchase is the pure income of parent company. Gain on bargain purchase is the pure income of P company. So we will be adding gain. Wait. Okay. So gain on bargain purchase will be pure income of parent company. So we'll add it 1990. Okay. The next thing. Then we have, remember the contingent consideration, the expense of contingent consideration, how much it was? 940. 940. It will reduce your profit. Okay. Then income from Bala. Remember the associate, there was a 210, 210, 210 was income from Bala. Then they are saying exchange difference. No, don't write here. Exchange difference is exchange gain or loss on foreign operation goes in OCI, and I'll take it in OCI. Don't worry, I'll take it in. Right now we are correcting profit. Then loan note finance cost. How much extra finance cost we need to book? 324. Extra finance cost is 324. Then remember the loan note remeasurement, the fair value through OCI, the fair value change of fair value through OCI. This is also goes in OCI. So my dear student, leave it. Now kindly calculate the total horizontally this total. Out of 6 transactions, we just posted 4 only. Okay, so it is 47234. The first thing is done. Now let's go to other comprehensive income. In other comprehensive income, yes, exchange difference of Bala. Exchange difference of Bala. Where is it? Yes. See, exchange differences on translating foreign operation. So exchange difference of Bala was, I think, or sorry. See, we have a separate line. Share of OCI for joint venture. It was how much? It was 990. Okay. Then we have loan note remeasurement. Yes, loss on, see the screen, x-axis and y-axis both. Loss on fair value through OCI, it was 94. So loss minus 94. Okay, so let's come to the right hand side. So first thing we need to bring is 2320, this, the existing one. Then we need to bring this 94, then we need to bring this 94 here. Then we need to bring this 990 here. Okay, so finally this total will be, let me add it. Yes, 3216. This total will be 3216. Now wait, this is the profit, C, and this is your other comprehensive income, the total of other comprehensive income. So let's apply the formula. This plus this, yes, 50450. This is your total comprehensive income. Yes, let me, yes, you can see. So let me reduce it a bit. Yes, so right now I have just done the total working, or in Urdu language we say hum wala kaam maine kiya hai. 100% adding together I have done. But the most important area is now we need to show the breakup of profit attributable to, first thing we'll do, profit attributable to equity owners of fee company and NCI, and the second thing we'll do, total comprehensive income attributable to P company and NCI. Okay, let's start. Be careful. See, they have already given you these numbers. They have already given you these numbers. They have already given you these numbers. These numbers they have given you. So these numbers are already unadjusted. Okay. So let's start. First of all, I'm going to write the total profit here. The total profit here. Total profit here. I'm going to break. So the total profit using 100% is 47234, and NCI will be my balancing number. NCI will be my balancing number. Okay, so what I'm doing, I'm going to calculate this number, profits attributable to equity owners of P company. So now few things we need to adjust. Whatever we adjusted in the profit, see 1990, whatever we adjusted here 1990, then in the second column we adjusted, I hope, yes, 940, there was a contingent consideration loss. Then in the third column, wait, let me check the third column. Third column is income from Bala. Yes, income from Bala will be added 210. Then there was interest income of 324. That's it. These four things were related to profit. Right now we are just doing profit. Right now we are just doing profit breakup. No total comprehensive income. So let's apply horizontally. Let's add these things horizontally. 40254. Now take the difference yourself. Take the difference yourself. 47254. 6980. 6980. Okay, there is one shortcut which you can apply. Why? Because in this question there was no adjustment with NCI. There was no see, all 6 transactions were purely related to parent company. All 6 transactions were purely related to parent company. Purely related to parent company. All 6 transactions were purely related to parent company. So you can also do like this, that simply copy paste this NCI. See, the NCI which was ready made given in the question, you can write here, and then you can do this balancing as well. But I have taught you with both methods. I have taught you with both methods. Okay, now the same breakup you need to show for total comprehensive income. Now just pick the total comprehensive income which was added 100%. See, this is the total comprehensive income, adjusted one 50450. 50450 is the total comprehensive income. Okay, now one method, there are two methods which you can follow. The first is pick this NCI directly here, and then calculate the above number as a balancing number. Then calculate the above number as a balancing number. Okay, and the second method is wait, all the transactions of profits and OCI which we just did, just adjust here. Why profit? Because total comprehensive income is also linked to profit as well. Total comprehensive income is connected to profit as well, and this number, this 40526 is the unadjusted number. So we need to adjust everything of profit and OCI. So it was 1990. Just for your sake I'm doing, otherwise you can apply the shortcut as well. Then minus 940, these are profit things. Then 210, then wait, then you have a 990 OCI. This is OCI. Okay, then we have 324 interest income, and then finally 94 loss. Let's see what happens. See, 43006, and now take the difference. Now apply the formula, equal this minus C7444. Or if you want to apply the shortcut, you may apply the shortcut. How shortcut? This 50, this 50450, less 7444 ready made, because no adjustment to NCI, and you will get this balancing number. This balancing number you can calculate it as a balancing number. Okay, this as well as this as a balancing number. Okay, so it's your wish. The question is done. The question is done. Yes, it's something new, it's something good learning for you, so that's why I've recorded this question. If you like it, please share with your friends, because I'm posting this on YouTube, and you can also comment it. You can also comment your feedback on the comment section. Okay, please check it out. This is the first part, the total part. Okay, this is the first part, you can see, and then this is the second part. This is the profit distribution part. Okay, this is the profit distribution part. So that's it for today's class. Thank you and take care. Bye bye.